Imagine waking up one morning to find that 85% of the nation's wealth has suddenly changed hands. On 19th July 1969, that is exactly what happened. Not a robbery, but the law. Today, we decode the overnight heist of Indian banking. To understand the crackdown, we need to look at the broken system. In the early 50s, India had 400 plus commercial banks. Scale was not the issue, distribution was. These banks would serve only the urban elite. In the first phase, the era of exclusion, banks were an urban phenomenon because they were heavily concentrated in the three port cities of Bombay, Madras, and Calcutta. As a result, agriculture, the primary driver of GDP, was entirely outside the formal financial net. Another problem that plagued the Indian banking landscape was ownership. These banks were owned by large industrial houses. Central Bank by the Tatars, UCO Bank by the Birlas, and so on. They would take deposits from the people, and these deposits would fund loans. That's how a bank works. But what if the loans weren't evaluated on merit of the borrower, but rather going back to the same companies that owned the bank? This conflict of interest that the banks faced led to the problem of connected lending. The banks were serving corporate empires rather than the developmental priorities of the nation. Something had to be done. The first step was nationalizing the Imperial Bank with the SBI Act of 1955. RBI acquired a 92% stake and the Imperial Bank became the State Bank of India. This signaled the beginning of a phase of state control that would go on for decades. But the problem persisted. Banks were meant to finance national development. So the finance minister, Morarji Desai, in 1967 started the social control experiment. He said, "We are the government. Why do we need to own the bank also? We will just tell the bank what to do and they will do it. Simple. Regulate the banks via National Credit Council without actually owning them." Practically, this would take a long time to work. The nation and the Prime Minister Indira Gandhi did not have that much time. So, in 1969, Morarji Desai was dismissed. And on 19th July of the same year, Indira Gandhi government brought an ordinance that nationalized 14 banks overnight. The criteria was simple. Every bank with deposits over 50 crore. These banks represented 85% of the total bank deposit, snatched from private ownership and put into government hands overnight by an ordinance. There was bound to be backlash, and it led to the landmark R.C. Cooper versus Union of India case of 1970. It went to the Supreme Court, and the Supreme Court ruled in favor of R.C. Cooper. The ordinance and subsequent act were struck down. But Act of Nationalization wasn't unconstitutional. Only the compensation was. So the Indira Gandhi government said, "Fine, another ordinance." On 14th February 1970, compensation revised, banks remained nationalized. Now came the tougher part. We own the banks now, but how do these banks reach the masses? And so to answer this, a study group was formed under economist D.R. Gadgil. He proposed an area approach to banking. Divide the areas among the banks and let them conquer. Nariman Committee formalized this into the lead bank scheme. Under this scheme, every district was assigned to a lead bank, which was a primary bank responsible for development of financial systems in that particular district. Crucially, this bank will not have a monopoly. Other banks could also enter the area, which forced the lead bank to develop its services and remain competitive. To go deeper and reach the village, a service area approach was devised in 1989, wherein the target was set to have at least one branch for every cluster of 15 to 25 villages. Distribution was achieved, but profitability remained a problem. Large commercial banks, with their well paid employees, could not remain profitable in the low revenue rural branch. A branch in a village which has only a few thousands in loans could not even pay the salaries of the people who worked there. The model was just not sustainable. And to solve this, the Narasimham Working Group was formed in 1975. This working group proposed a novel approach: regional rural banks, or simply called RRBs. These were a mix of commercial banks for professionalism and the local feel of the cooperative. The RRB Act was passed in 1976 and the Pratham Gramin Bank was established in Moradabad with the sponsorship of Syndicate Bank. The primary approach of this hybrid model was ownership, a 50-35-15 model. 50% from the central government, 35% from the sponsor bank, and 15% for the state government. To solve for cost, the salary was kept at the state government pay scale, and OPEX was maintained to keep them viable. It worked. It was perfect until it wasn't. Worker unions demanded pay parity, and RRB salaries and OPEX equaled their commercial counterparts. High cost structures returned and pushed the RRBs into the red, eventually paving the way for consolidation and mergers. In 1980, when Indira Gandhi returned to power, a second wave of nationalization appeared. This time, 6 banks were on the radar. The criteria: deposits greater than 200 crores. And so, 92% of banking became state controlled by 1980. The phase of 1947 to 91 thus saw a shift from class banking to 2 waves of drastic nationalization and reforms, and a period of intense expansion to make banking accessible. But the systemic dangers remained. What happened post 1991? We'll explore that in next video. Stay tuned.